You had a profitable year. The account grew. The trades worked. You feel pretty good about yourself. Now here's the uncomfortable question. How much of that was you? Not the strategy, not the discipline, not the screen time. You. How much of your gain came from skill that you can repeat next year in different conditions? And how much came from being in the right place at the right time, riding something bigger than your decisions? Most traders will not honestly ask this question because the answer is hard, and the answer is usually less flattering than the gain felt. But the traders who don't ask it will eventually be made to ask it by a different market, a different cycle. Today we're going to talk about how to honestly tell the difference before the market forces the question on you. Welcome back. This is episode 17 of the Perp Trading Psychology series, Arc 3. Last episode was about decoupling identity from the account. Today is about decoupling self-image from short-term results. These are related but different. The identity trap is about who you are. The attribution trap is about how good you actually are. And the second one is harder. Because attribution requires honesty about variance, sample size, and luck. Three things every confident trader hates to think about. Quick explanation of the problem. Imagine two traders. Both had a 50% year. Trader A took 50 trades, won 30. Average risk reward of 2 to 1. Their edge is mathematically clear. Trader B took 5 trades, won 3. 2 of those wins were massive. The other 2s were small. Same final return. Completely different signal about skill. Trader A has shown an edge they can probably repeat. Trader B has shown nothing. They might be skilled. They might also be lucky. 5 trades isn't enough data to know. The trader sitting in the chair usually feels equally confident in both cases, because confidence is generated by the result, not by the sample size. This is the core problem with attribution. The brain doesn't naturally weight evidence by how strong it is. It weights evidence by how recent and how big, which is exactly the worst weighting scheme for evaluating yourself as a trader. The neuroscience of attribution bias is interesting. When you make money, the brain runs a story generation circuit. It looks at what you did, looks at the outcome, and builds a narrative that connects the two. I bought because I saw the breakout. The breakout worked. Therefore, I am skilled at spotting breakouts. This story feels true. It might be true. But the story is generated regardless of whether causality actually existed. The same circuit fires whether you genuinely identified a high probability setup or whether you took a random long in a market that was going to rip anyway. The brain doesn't know which one happened. It only knows you took action and won. And it builds the same flattering story either way. This is called outcome bias by behavioral economists. And it's one of the most robust findings in the field. Humans systematically credit themselves for outcomes that had a large random component. For traders, this means every winning year teaches you the wrong lessons unless you actively correct for it. There's a specific market phenomenon that destroys attribution clarity. The bull market genius effect. In a strong uptrend, almost any long strategy makes money. Buy breakouts, works. Buy pullbacks, works. Buy because you saw a tweet you liked, works. Buy because the candle was green, works. The market is providing the edge. Your strategy is just selecting how to participate. But the trader's brain doesn't see it that way. The brain sees you making decisions and seeing those decisions rewarded. So the brain concludes you have skill. Bull markets, in this sense, are educational poison. They teach you that your decisions matter more than they actually do. The bear market that follows is the corrective lesson. Suddenly the strategies don't work. The brain is confused. Wasn't I skilled 3 months ago? What changed wasn't your skill. What changed was the environment that was rewarding your skill, and until you can separate my decisions from the environment that made my decisions look smart, you cannot honestly evaluate yourself as a trader. There's a related trap. The selective memory pattern. When you remember your past trades, you don't remember them evenly. You remember the spectacular wins vividly. The painful losses you remember in fragments. The hundreds of mediocre trades in between you don't remember at all. This means your felt sense of how I trade is constructed from a heavily edited highlight reel. The reel makes you look like someone who hits home runs occasionally and takes manageable losses. The actual statistics, if you ran them, would show a much messier picture. Probably more break-even than spectacular. Probably some losses worse than you remember. Pros run the statistics. Amateurs run the memory. The gap between those two pictures of yourself is exactly the gap between honest attribution and self-flattering attribution. The longer you go without checking, the wider the gap grows. There's a specific archetype I want to describe. The one good year trader. Every market cycle produces a wave of these. Traders who had a breakout year, usually during a strong trend, and now think they've cracked the code. They quit their day jobs. They start trading bigger. They build identities around being a trader. And then the cycle changes. The strategies that printed during the trend start failing in the range. The setups that work stop working. The account starts bleeding instead of growing. For the one good year trader, this is shocking. The information they have about themselves, I am a successful trader, is contradicted by the new reality every day. Most of them don't survive this contradiction. They either revenge trade trying to restore the old reality, or they quietly stop trading and go back to their original career, carrying a permanent confidence wound. The ones who do survive go through an honest reattribution process. They look at their one good year and ask the harder questions. How much of that was the cycle? How much was actual edge? What part of my behavior do I want to keep? And what part was just along for the ride? This is painful. It feels like deconstructing yourself. But it's the only path to becoming a multi-cycle trader. The one-cycle trader believes their first year proves something. The multi-cycle trader knows that 1 year proves almost nothing. The proof comes from surviving multiple cycles, including the ones that disagree with you. There's a cultural amplifier on attribution bias. Social media, especially trading Twitter, runs almost entirely on highlight reels. Traders post their wins, almost never their losses, except as a, look how disciplined I was to take the stop, content piece. When you scroll a feed of highlight reels, your brain calibrates your expectations against them. You start feeling like maybe you should be hitting these kinds of moves regularly. Maybe your boring grind is somehow less than what real traders do. The reality, of course, is that the boring grind is what real traders do. The highlights you see are the unusual moments, not the median. The trader who calibrates against the public narrative of trading is calibrating against fiction. And the consequence isn't just envy. It's distorted self-evaluation. You start judging yourself by impossible standards. You take bigger risks, chasing the kind of trades you see online. You blame yourself for not being someone who never existed. The fix is, recognize that what you see in public is selection bias squared. Selection of the best traders, posting their best moments, edited for clarity. You're calibrating against a fantasy. Your job is to calibrate against your own honest statistics. And that requires never letting the public picture distort your private one. There's a flip side to attribution bias that's worth describing. The loss-attribution distortion. When you make money, you over-credit yourself. When you lose money, you do the opposite. You under-credit yourself for the loss. Watch what your brain does after a bad trade. The story almost always involves something external. The market manipulated the price. The news was random. The setup was a fake out. The whale dumped on you. These stories might be true. They are also exactly the stories your brain is incentivized to generate, because they protect the identity from having to integrate the loss as your responsibility. A truly honest attribution would ask, even if those things happened, would a more disciplined version of me have taken that trade? Was my sizing too big? Did I move my stop? Most losing trades, examined honestly, have a personal component. Some part of the loss came from your decisions, not from the market. The asymmetry is brutal. You credit yourself fully for wins and externalize losses to factors outside yourself. The net effect is you systematically overestimate your skill. Year after year, cycle after cycle, until reality forces a correction. The pros do the reverse. They undercredit themselves for wins, looking for what was luck and credit themselves for losses, looking for what was personal failure. This sounds painful, but it's actually the asymmetry that creates long-term improvement. You can't improve what you don't see clearly. Honest losers see their losses clearly and adjust. Dishonest winners see only their wins and stop adjusting. There's a leverage angle worth describing. On perps, where account swings are big and fast, attribution becomes even harder. A single trade can move your account 50%. Was that skill or luck? The honest answer is, you can't tell from a single trade. Even from a series of high leverage trades, the sample sizes are too small and the random component too large to evaluate cleanly. This is why perp traders are statistically the most overconfident traders in the market. They get the strongest reinforcement signals, the biggest wins, the biggest losses. But those signals carry the least statistical information. The brain doesn't care about that. It just sees the magnitude. A spot trader who makes 10% in a year has a meaningful signal. They probably have skill. A perp trader who makes 10% in a week from a single big trade has almost no signal. They might have skill. They might also have stumbled into a moment. They cannot honestly tell. This is why long-term perp traders, the ones who survive a decade, are unusually humble. They've learned through painful repetition that the strong signals their brain generates from individual trades are mostly noise. So how do you actually attribute results honestly? 3 practical rules. 1. Use long enough sample sizes to be statistically meaningful. For most strategies, this means at least 100 trades before drawing conclusions. Not 5, not 20, 100. If you haven't crossed that threshold, you don't know if you have an edge. You have a result, which is different. The pros wait for the sample. The amateurs draw conclusions from the last 10 trades. 2. Separate your returns into market beta and personal alpha. This is a finance concept that applies brutally to trading. Beta is what the market gave you. If BTC went up 200% and your account went up 150%, your skill was actually negative. The market was generous, you underperformed it. Alpha is what your decisions added on top of the market. When you evaluate yourself, the question isn't, did my account go up? It's, did my decisions outperform what a passive position would have done? Most retail traders in bull markets generate negative alpha. They make money, but less than they would have made just buying and holding. They mistake beta for alpha. The clean way to evaluate yourself is beat the simplest benchmark. If you can't, you have a hobby, not an edge. 3. Journal your reasoning before the trade, not after. This is the single most powerful attribution tool that nobody uses. Before you take a trade, write down exactly why you're taking it. The setup, the conditions, the expected outcome. When the trade closes, compare reality to the prediction. Did your reasoning predict the outcome? Or did the outcome happen for reasons you didn't anticipate? If you predicted a breakout and got a breakout, that's skill. If you predicted a breakout and got a fake out that reversed back to make you money for unrelated reasons, that's luck. Most winning trades, when honestly journaled, turn out to be partly luck. That's not a flaw in you. That's the nature of markets. The trader who journals reasoning before the trade has a permanent record. They cannot self-deceive about attribution after the fact. The trader who doesn't journal can rewrite history in their head every week, and they will. There's a flip side worth knowing. When you start attributing honestly, your confidence goes down at first. You realize a lot of your past wins were luckier than you thought. You realize some of your losses were better played than you remembered. You realize your edge, if you have one, is smaller than your peak emotional state suggested. This feels bad, like you're not as good as you thought. But here's the gift. Once your confidence is calibrated to reality, your sizing matches your real edge. Your expectations match your real win rate. Your tolerance for drawdowns matches your real exposure. The traders who survive decades are traders whose confidence and competence are aligned. They don't believe they're better than they are. They also don't believe they're worse. This is what professionals in any high variance field develop. Honest self-assessment is the foundation everything else is built on. The trader who can honestly say, I have a small edge that pays me a modest return over time, is more dangerous than the trader who believes they're a genius, because the first one will still be trading in 10 years. The second one will have blown up and quit. To summarize today's episode, skill versus luck attribution is the foundation skill of long-term trading. The brain naturally credits itself for outcomes that had large random components. Bull markets are educational poison, teaching you that your decisions matter more than they actually do. Selective memory keeps the highlight reel running. Social media amplifies the distortion by feeding you a curated stream of other people's best moments. Perp leverage makes attribution harder by amplifying the noise relative to the signal. The 3 practical rules: use samples of at least 100 trades before drawing conclusions, separate market beta from personal alpha, and journal your reasoning before the trade so you cannot rewrite the attribution later. Underneath all of it is the same recurring lesson of trading psychology. The traders who last are the traders who know themselves accurately. Not flatteringly, accurately. Confidence that doesn't match competence is fragile. it will get broken by the market. The only sustainable confidence is the kind that survived honest examination. In the next episode, we're going to talk about the variable that decides more outcomes than any setup, any entry, any exit. Position sizing. How a single discipline, knowing exactly how much to risk per trade, separates traders who compound over decades from traders who blow up in months. Why most retail traders size emotionally instead of mathematically. And the simple framework pros use to keep position sizing on autopilot, even during tilt. If today was about being honest about how good you are, the next one is about how that honest assessment should translate directly into how much you're allowed to risk. Appreciate you all for listening. If this episode found you on a good streak, take a breath before you size up. The streak might be skill. It might also be the market handing you something. Honest attribution is the difference between the trader who survives the next cycle and the trader who doesn't. Subscribe and share with anyone whose confidence has outpaced their results. And I'll see you guys in episode 18. Start trading now on Mosey Finance. Trade perps everywhere with one dashboard. Link in bio.